Hey everyone, it's Jonathan. Today I want to talk about unusual options activity because I think this is one of the most misunderstood things in options trading. I was a market maker for 4 years at the Chicago Board Options Exchange. As a market maker, the only tool that we use to value options is going to be unusual options activity, and that's following the flow of the institutions or endowments or hedge funds or even really big traders. We want to decipher what those orders actually mean. And let me tell you why we use unusual options activity. Barron's came out and said this: off-exchange stock volume usually exceeds 35% and sometimes tops 40%. Now what this means, off-exchange is going to be dark pools. A dark pool might be an exchange between a group of banks that nobody can trade on except those banks and those banks' clients. So if you're trading off underlying stock volume, not options volume, just the underlying stock volume, please understand that you're not seeing the good stuff. You're only seeing 65%, 60%, and it's really not the influential volume. So therefore, trading off a stock volume is a very dangerous game. Here's the key difference between stock volume, which will be here on the left, and options volume. Not 100% transparent. We just talked about that with Barron's, because high frequency trading, block trades, and dark pools. Now dark pools, they never have to share what their volume is, and block trades share 15 minutes after the trades are done. Too late. Now, why we love options volume and why unusual options activity is such a buzzword and you see all the gurus talking about it, but most get it just wrong, is because it's transparent. There are no dark pools, there are no reporting delays, there's no block trades. It's 100% transparent. As a matter of fact, the options market has something called the NBBO. That's the National Best Bid and Offer. So if there's 10 different options exchange, and let's say for Microsoft, here, let me open up an options trade. This will be easier to explain. Square. National Best Bid and Offer, last trade $40. Now if we scroll down and let's say we want to look at the 47 calls, 55-cent bid. This is the National Best Bid and Offer taking in all of the exchanges. So right now, if one exchange is 55-cent bid, say the PHLX or the Chicago Board Options Exchange, and then another exchange, the best bid is 50 cents, they're going to see 55-cent bid because in the options, there's the NBBO, the National Best Bid and Offer. So options volume is way more reliable. Actually, options volume is reliable. Stock volume is garbage. I hate stock volume. Anybody using an indicator for stock volume, if you're making money using that, you're a superstar trader because you're not getting good information. You're making money off that. That's great, but you're not seeing all the information. Imagine if you got to see real volume, what you could do. Unusual options volume is tricky. Square. Today, I was traded on the 35 strike. They bought puts. When you buy puts, if we were just to buy a put, it's the same as just getting short stock at 35, right? But what we need to do is we need to interpret this order because institutions, endowments, hedge funds, they know that traders are going to look at this and say, wow, I want to get bearish too because some gorilla just bought 8,700 puts. 8,700 puts. Once this gets in the money, once the stock gets under 35, this is the equivalent to 70,000 shares that are short, a significant amount of the day's volume. But we need to dig deeper because these guys know we're looking at them, so many times they're going to mask their order. So just because they buy puts, it doesn't mean it's always bearish. So watch what we can do. I'm using Thinkorswim for this example. Scroll down, options, time and sales. Now, if we look at these 35 puts, the 35 puts are going to be right here. 845. Chicago time. Mid-market, you can't read too much into that though. IV, the underlying was at 40.27. The underlying was about 37 cents higher. 8.45. Now if I go to the chart of Square and I put it on a 1 minute, 8.45 is going to take us right here. So after the trade, it was at 40.40. It dropped down 60 cents. They were actually buying puts. It was a very bearish trade. The reason I know it's a bearish trade is because, look, it's sold off. Okay? For sure, it's a bearish trade. I promise. If it's trading like this in a 1 minute and all of a sudden it's running up, and here 8,000 puts were bought and then it sold off 60 cents, I'm going to say with 99% certainty they're buying puts. It's a bearish position. But let me take you to another example. And this one, let's use ROST, Ross Stores. I saw a great example of this morning. So Ross Stores, 2,600. $64 last price, 65 strike, 2,600. So just think that this person is buying stock at 65. And not only are they buying stock, they're buying 260,000 shares. That's about 20% of the overall volume today. That's a pretty big order. But now we have to dig deeper because you can't just assume that somebody bought 2,600 calls that it's bullish. So again, we could scroll down. Time and sales. We find the order right here. It was done on the offer. Okay, maybe they're buying. They're probably buying. That's good information. 848. If they're buying this many calls, that's 20% of the overall volume. The stock should be going up, right? Well, let's see what we find. I put it on a 1 minute. Here's the opening. But 848 is going to be way up here. So what happened is ROST got hit on the opening. Rally back up, rally back up, rally back up. Then that massive trade was done right here. But look what happened after that trade. It didn't keep rallying. It sold off. Why did it sell off? Let me tell you. It sold off because they bought calls, but at the same time they bought calls, they sold the underlying stock. They did this to mask their order, to hide their order, because they weren't really buying calls. They did buy calls, but if you buy calls and at the same time you sell stock, you're synthetically buying a put. So that order, ROST, in December, 2,600 times to the experienced trader, to the market maker, this is a very bearish trade. They're buying calls, but because they sold stock, they're synthetically putting on a short position. The message is, unless you really understand unusual options activity, unless you feel very, very comfortable analyzing the unusual options activity, I wouldn't read too much into it before you learn how to properly do it. I absolutely wouldn't risk any money using that information until you get more confident and learn the proper way to do that. Okay? Hope that helps, guys. Jonathan Rose, active day trader.